Welcome to the Expert Exchange, the podcast where knowledge meets success, with your host, Joshua Carnes, and expert guest, Kit Webster. Today's show is brought to you by Lion Business Advisors.
The content in this show is for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice. The Expert Exchange is not a fiduciary by virtue of any person's use of or access to this content. The Expert Exchange is not licensed to practice law or provide legal advice. Nothing contained within this show is intended to be an offer to either buy or sell securities.
Welcome to the Expert Exchange, the podcast where knowledge meets success. On today's show, we are going to be talking about the process of selling a business in today's market with our expert guest, Kit Webster. As always, we will link to all of Kit's contact information on the bottom of the show and everywhere possible.
At Lion Business Advisors, selling a business is not just a transaction. You've poured your heart and soul into your business. It's not just a paycheck, it's your legacy. The team at Lion Business Advisors is here to guide you through the process, ensuring your successful exit. Contact the team at Lion Business Advisors at 800-525-3542. That's 800-525-3542, or visit us at lionbusinessadvisors.com. Lion Business Advisors. Let the story of your next chapter begin with us.
So get ready to expand your horizons and refine your strategies as we dive into selling a business in today's market. Kit, welcome to the show.
Thanks. Good to be here.
Before we dive in, why don't you take a moment, introduce yourself to the guest, tell us a little bit about yourself.
Well, thanks. It's a long story by now, as you can tell by the gray hair, but to put it shortly, master's in EE from Rice University. I'm a CPA. I got in the mergers and acquisitions business many decades ago, and I've done a lot of transactions on both sides. Mm-hmm. And in between, I've been chief financial officer, president, and chief executive officer of publicly held and privately held companies. Now I am spending my time advising buyers and sellers on how to do a successful transaction.
And on top of that, you're currently the senior M&A advisor at Lion Business Advisors, and we are grateful that you have taken that role, and you're killing it there. So thank you very much for that.
I appreciate it.
So let's dive into this. On the show, we've talked a lot about preparing businesses to sell and getting them ready to sell. Let's start with the basics. When is the right time for a business owner to sell their business?
I'm not sure there's a right time, but there's some typical times. There are times when are most likely for a seller to show up and say, it's time. Probably the very first time is estate planning. They've run a company for years, for decades. They've been successful, but they're getting old. Mm-hmm. And not only is time taking its toll on them, they need to do estate planning to make sure they've got the liquidity and have taken care of the next generation one way or the other. So they decide, very often reluctantly, that it's time to sell. This is their baby. They love it. They've done this. The people that work for them are maybe termed their children. But, it's the way it goes. And so they'll contact us and say, can you help? The second major reason I've seen is just burnout. Mm-hmm. You start a business, you work 15, 20 hours a day, 7 days a week for year after year after year. You miss your kids' football games. You miss a lot of things in your life. And all of a sudden you wake up one morning and you decide, there must be more to life. And so that you just say, I'm done. I want to get out of here. Those are the reasons we see most often. Mm-hmm. I guess the third one, which is less often, is just, I want money. I want, I'm not old. I'm not burned out yet, but I built a good business and I'd like to put some money in my pocket. I'm tired of, just paying myself whatever I'm paying myself. I want to monetize this thing and get out. So those are the three principal reasons that I see.
The big thing that I like to remind people around that is if you're thinking about selling, it's at least time to start the conversation with an M&A advisor. If it's on your mind at all, start the conversation with someone like you, and you can tell them, here's where you're at, here's what you can walk away with today, or you need to do more estate planning. You need to talk to your financial advisor and things like that. So it's never too late, never too early to start the conversation.
Well, particularly, there's no obligation to talking with us, to talking with me. Call me up. We'll talk about it. Here's where I am. I've got these problems. I see these opportunities. Talk me through it.
Mm-hmm.
I had a guy about 3 or 4 months ago. He called me up. We went through all this.
Mm-hmm.
And he said, I'm not ready, but I'm going to call you back in a year and we're going to have this same conversation.
Yep.
Fine. That works. That works for me. What we want is to get you the best out of what you want for your priorities. So, and the other reason it's never too early is that there's the opportunity to prepare your business to sell. If you're spending too much money, if you're investing in places that aren't going to show up in the time frame that you're going to sell the business, if you've got people on payroll, maybe that you shouldn't have for the most efficiency, what you do, and you got dead inventory you don't want hanging around, take some time to clean it up to get the maximum value. We'll talk more about that as we go along, but that just comes back to it's never too early.
I definitely agree with that. When, keeping with the basics here, and we're talking about selling a business, what exactly is it that business owners are selling when they go to sell their business?
Well, we're going to have a theme in this conversation that everything's negotiable.
Yep.
That you can't enter this kind of a transaction feeling like everything's going to go your way, everything's going to be exactly right. The buyer's going to have their ideas. You're going to have to do some negotiation. But I'll tell you the way the 90% of them go down, and it's in 2 categories.
Mm-hmm.
The first category, which for most businesses is called an asset deal. And in an asset deal, it's pretty much what it sounds like, only you're selling all of your assets, tangible and intangible, except the cash.
Mm-hmm.
So you're selling your name, you're selling your website, you're selling any trademarks that you have, you're selling your accounts receivable, you're selling your inventory, you're selling your furniture and fixtures. You're keeping the liabilities. Now, the reason for that kind of transaction is that buyers, there can be hidden liabilities that they can't find and maybe you don't even know about, and buyers just don't want to deal with it. They want you to keep your liabilities. They're going to take your assets, and so you do an asset transaction. The other kind of transaction, which is done less often, is called a stock deal, and it's pretty much what it sounds like. Depending, even if you're an LLC or if you're a partnership, the point of the stock deal is you're selling the entire company. You're selling the assets. And the buyer is assuming your liabilities. They're assuming your debt. They're assuming your accounts payable and any other obligations that you might have. Again, less often because the buyer just doesn't want to deal with liabilities. They want you to take it, for them to go away, and for them to go forward with your business on a clean basis.
Generally, the asset sales are on smaller deals. Stock or membership purchases are on larger deals. Or if a seller has contracts that are tied to government contracts that are tied to the actual EIN number of that company that they'll lose if they sell, that's when we'll see a stock sale or a membership sale. Comically, today I had a conversation with a potential seller, and he said, well, my CPA told me to do a stock sale. And roughly looking number is going to be about $500,000 business. We had the quick conversation of, yes, I bet your CPA did. There's a lot of benefits to the seller on doing a stock sale, but as you go back to, it's the liability. Most buyers, especially on Main Street businesses, just aren't going to buy the liability of the average mom and pop business.
That's right. And I want to talk about the definition of small businesses, because we're doing asset sales in the for businesses that have 50, maybe even $100 million in sales, or maybe even higher.
Mm-hmm.
So different people have a different idea of what a small business is. It's not your mom and pop business. This can be a very big, very established business that still does an asset deal. But as you get bigger and bigger, there's more of a tendency to go to a stock deal.
Correct. Speaking of buyers sometimes not wanting to buy the liability on a company, what are some of the big things that buyers are looking for in these businesses?
I think, again, it depends on the buyer. But again, if you go to the top two, number one is cash flow. I mean, the buyer is going to buy your business and they're going to assume some debt.
Mm-hmm.
So what they're going to want not only is for you to have a viable business, but for them to see the way forward to sell the debt that they've used to buy your business, which leads me to the second point that buyers are looking for, which is growth. They want to buy something that they can build on, that they can not only for the money, they want the growth to have a bigger business, but there's also, for most people, more satisfaction in growing a business, achieving growth. And so those are the things that buyers are most often looking for when they're buying a business. It gets a little bit more touchy-feely, though. Buyers are sometimes, they're looking for something that's compatible with themselves. They're looking for a culture that they can ease into, that they like. So sometimes the intangibles become as important as the financial issues. But most often, the things that are going to lead them to the company, the intangibles are going to be important when it comes to closing. But in terms of just saying, yeah, I'd like to take a look at this company, it's revenues, EBITDA, growth prospects.
Mm-hmm. I think it's also interesting to point out, I think it's a unknown thing that happens in this industry. The current stats are less than 2% of buyers buy within their first 24 months of going out to look for businesses. And so knowing what buyers look for and how to manage buyers is a skill set all in of its own that requires a seasoned person like yourself to filter through the sometimes hundreds of inquiries that come in on a business.
That's exactly right. I'm in the midst of an acquisition right now. It's a nice company. It's a good sized company. We had literally over 100 interested parties, and one of our jobs, is to filter through those, not only to qualify them, to make sure that they are qualified buyers and that they are real people, but when you filter through those people and get to know them, to understand whether they are a match, whether their businesses are a match, and whether they are a good fit for the company. So we spend a lot of time, I guess, a half maybe of my time is spent just basically with buyers, working them through the process, whether it's a fit, understanding them and what it is they need.
Speaking of process, what does the overarching process of selling a business look like?
Well, the first thing that you need to decide is whether you want to engage a broker. And so you want to engage a broker for a whole list of reasons, but the principal reasons are we do the marketing. We've got lists of potential buyers. We've built over years people who want your kind of business. Secondly, we put together really nice marketing packages, multi-page, multicolor, quality pieces to go out to represent your business in a quality way. And then thirdly, we go out on the usual places, the internet, not only the usual places, but places for specific buyers that aren't generally known. The second thing that we provide is advice. We're not lawyers. We're not accountants. Well, I'm a CPA, but I'm not your advisor. Okay. You will have your own CPA advisor. But we've been through this 100 times, so we know what to expect, what things look like, how you should react, what we've seen before. So the process is that we get to know you, we get to know the company. You send us financials, and with no obligation, we go to our databases. We've got a database of essentially every transaction that's been done by industry to tell us what the parameters of that kind of transaction are, because different businesses of different size and in different categories and different areas have different what are called multiples or factors that go into calculating your price. So it's not just a matter of what is your EBITDA, what are your revenues. It's what multiplier do we put on that, and what range should we expect? Because this has some similarities to selling a house. There's not a number, there's a range. And so what we can do is come back to you and say, look, here's the range. And what we're going to do is recommend that you list on the high side of the range. And the reason we're going to do that is because the buyer is going to negotiate. So wherever unless it's just I've had transactions where this hasn't been the case, but it's rare and it's wonderful, where a buyer just comes in and you get asking price. That's not going to happen. So what you do is you're going to get negotiated down. And so whatever the range is, you should be on the high end, but not so high that you drive people away. One of the problems that you have is a buyer is looking at your list price and they're saying, well, they're going to come down from it. But even if you come down a sum, it's not a reasonable price according to them, they're not going to give you a call. So there's a real art to picking the number that's on the high end that gets you the phone call. And that's what we do. No obligation. We hand it to you. If you like it, then we enter into an agreement. And what we say is we're going to list you for a particular amount of time. A typical transaction takes 6 to 9 months. Within 6 or 9 months, we're going to know if your business is going to sell or not. Yep. We ask you for a small amount up front to help us with the marketing costs. Otherwise, everything is on us. And the commission is usually 10%, but for large deals, it's lower. That's it. That's the agreement that we reach. And then we get busy. What we do is we screen the buyers as they come in. Some companies are easier to sell than others. Yeah. This company I'm working with right now that I just described earlier is a nice company. Everybody wants it. We're going to get some good offers. Whether we're going to reach a closure or not, it's a whole different deal because the buyers and the sellers are going to look at it differently. Some companies, and mostly sole proprietorships, are really hard to sell.
Yeah.
Not impossible. I just did it. I don't remember, maybe 6 months ago.
You've actually done it a couple times, in case you were wondering, in the last few years. So
yes, I have. So it is possible, but it's really hard.
It is.
And so if you have a sole proprietorship, you need to expect that it's going to be much more difficult than if you have an attractive business. Okay, so we go through all these buyers and these sellers, and what happens, it varies a little bit, but we'll take you down the main path. Mm-hmm. We usually have a video call, and you and the buyer introduce each other, get to know each other a little bit. If they want to take the next step, you visit the company. Something I omitted up front, this is confidential. Mm-hmm. Everybody we talk to enters a non-disclosure agreement so that we are only disclosing those things that you want to disclose to people who have signed a non-disclosure agreement. So we don't disclose customer names. We do not disclose vendor names. We do not disclose employee names. We're running a confidential search, a confidential marketing campaign to get you the buyer that you need. So when they visit the company, very often they do it after hours. I just had one this weekend, and the seller did not want to disturb anybody, let them know what's going on. So we showed up at 9 o'clock in the morning, and we met, and the buyer and the seller got to sit down and get deeply into what they wanted to do. Around this time, any interested buyer has gotten the information on the business. They've had a video call.
Mhm.
They have visited the business, and now it's time for either an IOI or an LOI. Now, an IOI is an indication of interest. It's just I'm interested in buying the company, and here's a range that I think I want to buy it at. It's an early filtering mechanism where we can say, nah, you're just way too low, or okay, let's talk more. An LOI, or letter of intent, is not binding, but it is the basis for negotiation. It is a letter that lists the top issues or terms and conditions for the buyer buying the company. There's a lot more to buying a company than selling price.
Yeah.
Their terms is the seller going to assume a note? Are they going to get bank financing? What's the down payment? Is there going to be an earnout? Is the seller going to consult with the company after the closing?
And for how long?
Well, that's always a key point of discussion. And are the employees going to come along? So once you get you negotiate the LOI, you basically then are agreeing on the principal terms of the acquisition.
Mm-hmm.
Then you get to the stage called due diligence. And in due diligence, up until now, the buyer does not know the names of people. They've gotten the information we've given them. They've only looked at the company. But now the buyer has access to everything. Customers, they're kicking the tires. They are making the final decision as to whether they're going to buy this company.
I like to say they're looking for a reason not to buy. And it's time to open up the doors and make sure that they do buy. That's your job.
Yeah, it really is. Although, and one of the conversations I have with sellers is, but because sellers are justifiably proud of their businesses and all they've done, but I have to let them know that buyers don't care that much, and that buyers are scared because what they're going to do is spend millions of dollars on a company based on really doing some good work, but again, it's kind of jumping into the unknown. So due diligence is kind of the time to either do it or don't do it.
Yep.
Because at the end of during due diligence, the buyer's attorney is drawing up the purchase contract. And the purchase contract incorporates the terms of the letter of intent plus all the legal stuff, all the just, the boilerplate that always goes into contracts. Due diligence is done, and then you negotiate the final contract, and then you have closing. Closing these days can be completely electronic. You can be sitting at home, you sign the agreement, and the money shows up in your bank account. I just closed one where the buyer and seller wanted to get together, and they actually along with the banker. It was an SBA loan, and they all wanted to get together and have a party and celebrate. That's great. I'm always glad to see that happen because it starts off the closing on a good note. So that's a long way of saying there's a lot going on during the process, and there's a lot to be talked about and a lot to be done to ensure that this will be a successful transaction.
I think one of the biggest pieces out of that sellers need to understand, and why it's so important to have an advisor on their side, is every step of the way is another negotiation or the opportunity for another negotiation. Diligence, every item that comes up that wasn't fully disclosed or wasn't fully vetted out is another opportunity for negotiation. And so it's really important to have an advisor on your side that knows all the ins and outs so that they can protect the seller during those negotiations, because any conversation can instantly turn into another negotiation.
Absolutely.
So we've kind of hit on the overarching process. Let's go back to the beginning of that process, setting an asking price or a valuation. How do you value the average business?
I ask you for 3 years of financials. What we then do with the financials is we compute. It has different terms. For the purposes of this conversation, I'm going to call it adjusted EBITDA.
Mm-hmm.
And what that EBITDA is just a fancy term for take your profit, add back any depreciation, any amortization, and any interest, and then you get EBITDA, earnings before interest, depreciation, and amortization. We're going to add back more things because the number that we actually base the valuation on is the number that the buyer is going to have to parcel out and allocate to their different operations.
Mm-hmm.
So the first thing we add back is the buyer's compensation. The second thing we add back is any unusual transactions. And then the third thing we add back are any personal expenses that the buyer is incurring, that the seller is incurring, and the buyer will not have to incur going forward. So we're creating this adjusted EBITDA to provide the basis for valuing a business. Now, again, I've said this several times. There are different ways to do this, and I'm going down the main path. And I'll talk about some additional paths in a minute. So once I've got the historical adjusted EBITDA and revenues for the company, and we know what all's in there, we understand what the fixed assets are, what the inventory is, because the market value of inventory and fixed assets will be important to calculating, to one method of calculating the purchase price. Then we go to this database that I talk about. And in this database, we find out what the multipliers are. Now, simplistically, and I'll get into the complications in just a minute, simplistically, it says multiply the adjusted EBITDA times X, and that's your selling price. And that X depends on the industry and it depends on the size of the company. Some industries have higher X's, some companies have higher X's.
I think that's really important to hit on. Almost every industry has its own value range, and there are multiple ranges within those industries depending on the size of the business. A lot of times when we get these phone calls, we'll hear, my CPA told me it's a 3X multiple. Could be, but it could also be a 3.5, or it could be a 5, or it could be a 15, or it could be a 2. And it's really important to get with a professional such as yourself to find out what your specific company in your industry and the size of your company, what that range is going to be, because that's the basis starting for all negotiations. And so it's a small piece that's a quick piece on our side, but it's a really big piece that the average business owner is going to miss if they don't have an advisor on their side.
Average business owner, the average CPA, the average attorney, all of them are going to miss this because it is that critical point. Now we get into various ways to approach valuation. And what we do is we value your company based on different approaches. For instance, if you're not making much money, we'll try to find a valuation based on revenues. So there'll be a multiple of revenues. There's another approach to valuation that has a different X, let's call it Y, where we also add back the value of your inventory, your receivables, and your fixed assets. So what we do is we go through all of this because we're going to have to justify this to the buyer. The buyer's just not going to come in and say, "Yeah, I really like your valuation." I have to send them or I have to give them an explanation of how did I get to this number, and so I have to document it and I have to show that it's reasonable and customary. But what we'll do is we'll find the valuation that works the best for you. And then we'll establish that range that we talked about earlier. We'll pick point at the top of that range. And then that's going to be the valuation we start out with. Now, let's talk about what happens. People are going to respond or not.
Mm-hmm.
If they respond, great, we're heading down the process. What can happen is there are either very few buyers for a business, or we for all the work we did, we picked the wrong number. So what'll happen after some period of time, 3-4 months maybe, we'll say this isn't working. Let's lower the price. So we still know what the value is, but remember it's a range, and that potential buyers are reacting to the list price. So what we'll do is we'll lower it, and then we'll continue the process.
What happens if you go through that process and you tell a potential seller, hey, I believe a suggested list price or a most probable sales price is X, and the seller doesn't like that number? What does that look like?
Josh, this is going to sound a little difficult. Sellers never like them. It's very rare when a seller says, "Oh, wonderful. I like your price."
I think it happened once.
Have you had it happen?
Where they were actually shocked and we were above what they were expecting. But
well, you go back to these intangibles, right? This is your baby. You've raised it. You've loved it. You've been through the fires with it. You've been almost bankrupt. You've had the contract that turned you around. You have all these experiences, and not only that, but you're greedy a little bit, maybe.
Mm-hmm.
But my job, and I think this is important, my job's to tell you the truth.
Yeah.
I'm not here to pump your tires. I'm here to get you to a successful transaction. And if you need some straightforward conversation, that's what you're going to get. Because if I say I recommend X, and you say X plus 1, I'm going to say, yeah, okay. We'll try it. Just understand we may have to come down.
Mm-hmm.
If you say X plus 5, then we're just going to have a conversation, because remember, I've got skin in this game. I'm going to be spending a lot of time, and I'm going to be spending a good amount of money on marketing and negotiating, not negotiating on your behalf, but talking about why we are where we are, what's good about your company, explaining your strengths, all those kinds of things. And if it's not going to work, it's not going to work. And if it's not going to work for both of us, it's not going to work. So that conversation becomes very important. Actually, I'll say that I have never had a seller that likes my price, but I will say that I have never, I need to be careful with this because I need to think past over decades, but I have never lost a prospect because of that price. We have a conversation. I have the conversation with him that I'm going to have with the buyer.
Mm-hmm.
Here's why it is. Here are my numbers. Here's where they came from. They're documented. It's arithmetic. Tell me where, other than you just don't like it.
Yeah.
Tell me why we're not going to do this. And ultimately, like I said, essentially, or everybody says, yeah, okay, I understand.
I think it's also important to point out there's a big difference for those sellers who are just not happy with the number today versus the educated business owner who says, well, I need X to walk away. And we're just not there today. There's a big difference in saying, I think it's worth more today versus I accept your answer and I need X to walk away, because both of us have several contacts that are industry specific, not industry specific, generic, that are consultants and coaches that specialize in exit planning and exit strategy that can help sellers who have realistic expectations to get to that goal. Working with the right financial planner can ensure that wealth gap is obtained, and working with the right financial advisor or CPA or just right partner in general can help that sellers realize what number they actually need versus what the business is going to go for. And a lot of times we can make up that gap in other ways with tax deferrals or a number of variations, or sometimes they just need to go back and they need to put another year to 2 years worth of work in it, right? So it's important to know that if you don't like that number today, know why you don't like it, and is it an actual number you need to walk away with versus something that is fixable, right? Because a lot of times there's fixable and we can get to a higher number if everyone's willing to work.
Agreed.
But then they got to put in the work. We have agreed on a suggested list price, and we agreed that we're going to go to market. Everybody's on point. We all like the numbers. When should a business owner begin to tell people that the business is for sale? When should they tell their employees, their customers, their vendors? When do you start telling people?
First answer is it's very personal. The second answer is most owners that I have worked with want to wait until the last possible minute. The primary reason for that is the deal may not close. You may not find the buyer that you want, and for whatever reason, and we'll talk about it and decide what it takes to bring the company back on the market, but it might not close. And so you don't want to have people worrying about their jobs, worrying about having some idiot come in to run the company. That's all just premature.
Mm-hmm.
So one of the primary conversations that I have with sellers is they say, when's the right time? And here's the answer I give them. Again, it's up to you, but I make it the latest possible time. And that's usually during due diligence. So because people are going to show up, they're going to start asking questions. They're going to start looking at your books online. They're going to start going through your point of sale. They're going to kick the tires on things. And word's just going to get out.
Yeah.
And so before due diligence starts, I recommend that you sit down with your staff and you just tell them the truth. And if you're going to be emotional about it, be emotional about it. Tell them that you've come to this, it's been hard, you've come to this decision, but here we are. And here is where I'm going to be going forward. Now, the awkward part of this conversation is the deal still may not close. Mm-hmm. But at due diligence, it's almost impossible to keep the cat in the bag. So at that point, you have the conversation. You tell everybody, you're going to be taken care of. You give them and tell them, I'm going to be around. The buyer's going to want me to help with the transition. So it's all going to go as easily and constructively as it possibly can.
I think it's this is one of those things where TV has killed it, because it's not like the movie shows where where a buyer comes in and guts it and runs everything. For the most part, they're buying the business because the employees made it great. They want those key personnel to stay behind. I mean, I would even venture so far, most transactions that we've seen in the last few years, those new owners or new buyers or potential owners are coming in and they want to give bonuses and give raises because they want those people to stay. You said that it's the fear factor of, we're all going to lose our jobs. The reality is most buyers today want to keep every employee that's there, and they're not going to make any changes right away. They're not going to come in and just gut it like you see on Succession or some movie like that. That's not most realities today. So
it actually works the other way very often. The last couple of deals that I've done have included demands for contracts with key employees. Mm-hmm. In other words, they've written into the letter of intent, it says employees X, Y, and Z must, in order for this deal to go through, employees X, Y, and Z must sign an employment agreement acceptable to both parties. And that this is not if there's a vulture coming, I'll see it.
Yeah.
And you just don't have those kinds of transactions, as you point out. It would be very unusual.
Yeah, most of the time they want everyone to stay on and they want everyone to be taken care of too. So it is a thing of it's a tough conversation to have, and it is, you kind of want to hold it off as long as possible. But generally speaking, most part, those employees are going to be taken care of. They're going to be taken care of well. And it generally works out well as long as everybody's above board.
Yep.
So, all right. So, we've kind of hit the overall process and talked about what it looks like to sell a business. Let's kind of get into your role as an M&A advisor, as a business broker. Those terms are kind of interchangeable in this industry. What does that look like? Why would a business owner use an advisor?
Two reasons, or again, two principal reasons. One is we can market the hell out of your business. We've been in this business a long time. We've got contacts. We've got what used to be called a Rolodex. I guess now we'll call it a database of potential buyers. My contacts over the decades have been extremely important to me in finding potential buyers for businesses. And we're going to prepare the marketing. We're going to go out there and market on your behalf.
And confidentially, we know how to market the business confidentially, which is a huge piece that I think a lot of people miss, is what differentiates us from real estate agents. We're not putting a sign in the yard. Nobody knows it's for sale until we're deep into conversations.
Yeah, no, that's an excellent point. And then the second point is an advisor. Like I said, I've been there, done that. I've been there, done that for decades, from everything from manufacturing to sole proprietorships to high tech. And so I can help guide you through the steps that it takes. Now, I want to make one thing clear before I make this next comment. I represent you. I do not represent the buyer.
Mm-hmm.
But what I have found is that the buyer needs help too.
Yeah.
And so what I do is I develop a relationship with the buyer. And I'm very clear up front. I say, I don't represent you. I represent the seller. You need to get your attorney. You need to get your accountant. You need your advisors. But if you have a question, I'll answer your question as best I possibly can, as long as it doesn't interrupt with my relationship with the seller. Now, that takes us a long way, because not only does it develop relationships, but it makes the buyer much more comfortable. I'm not on the clock, so he's not going to call an attorney and start a $300 an hour call to get what is a simple answer to a simple question that, through no fault of his own, he's just never done an M&A transaction before. He's not stupid. He's a very successful entrepreneur. He just hadn't been here before. Mm-hmm. So those are the two primary things. And so I can tell you what's going to come next. Many times I can tell you, here's what the buyer's going to do, and so be prepared. I can help you with your resources. If you don't have an attorney or a CPA, we can find you one to help represent you with your process. And along the way, I can give feedback as to how it's going, how you're doing, and I can give you personal feedback. Here are the things you need to do. One of the things I do in meetings, I'm big on body language. And so we have a video call or an in-person visit. I'm keeping my eye on the buyer and watching when they twitch and when they lean forward and these kinds of things. And so I adjust my conversation with you to say, you should probably reemphasize this. I don't think they got this. Trying again to get to successful conclusion.
I think you hit on one of the things that I want to expand on a little bit is you hit on those resources that we kind of bring to the table as far as attorneys and CPAs. A lot of times we'll get someone who goes, oh, I have an attorney, I have a financial advisor, I have this. For something like this, it's important to use someone who's specializing or at least has a higher familiarity with exits. This is, probably some of the worst transaction I've been a part of is when they go, oh, I have an attorney. Great. We meet the attorney, and that attorney is a family lawyer. He's used to family law or something like that. Attorneys are highly specialized, and we work with some of the best in the industry that focus on M&A transactions. And it's really, really important to get advisors and surround yourself with advisors who know what's going on in an exit, right? So even CPAs are great, but there's a difference in someone who's preparing your annual taxes versus the person who is about to prepare you for that wealth event. You need a financial advisor. You need these people. And someone like yourself who's been around as long as you have has those people in the pocketbook that know how to best represent sellers when they go through these wealth events. And a lot of people don't understand these are sometimes big wealth events, and they're not always prepared for what's about to happen from the money that they're going to get. So
Great point. And I want to mention one other set of resources that we have. If you need financing, you should rely on your resources, your contacts, your banks, whatever you wish to do. But if that's not adequate, or if you want to take a look at alternatives, we have contacts with bankers, including SBA experts, that can take a look at your business and give you feedback as to its financeability and what kind of terms they can help you on.
Mm-hmm. And I think that's really important too, where it comes back to you just have to have someone who's been around and have the relationships, because different banks like different industries, and they're willing to lend higher multiples in certain industries and lower multiples in certain industries. So if you use the wrong banker, you're going to get less money. And that's theoretically, that's something that's all on the buyer and all on the buy side, but that's a big role that we play in knowing what bank that buyer really needs to go to support the valuation that we believe that we can get. And, we work with banks all the time. Banks will do pre-flights for us. A bank will look at a deal and say, hey, if you bring me the right buyer, here's where we'll go. And those numbers can be different. And so having an advisor that's been around and has those connections will sometimes be the different and just end result to the seller's cash book. So Kit, thank you for coming on the show today. It's been a really good chatting with you, and I think we've given a great overview process of what it looks like to sell a business with Lion and you, what that process looks like. If anyone that's out there is interested in having a deeper conversation with you, how do they get a hold of you?
Two ways, or two principal ways. One is by cell phone or text, 512-658-9776. And the other way is just send me an email, kwebster, KWEBSTER, @lionbusinessbrokers.com. And I also recommend you can learn more about me and learn more about Lion Business Brokers by visiting lionbusinessbrokers.com.
As always, we're going to link to all of Kit's information down at the bottom of this post and on the website. If you enjoyed what you heard today and you want to keep this conversation going, you can find more about the show on the expertexchange.pro. That's the expertexchange.pro. For more resources, you can reach out to Kit and everyone at the team at lionbusinessbrokers.com. Remember, success is a journey, and we're thrilled to be a part of yours. We'll catch you on the next episode of the Expert Exchange. All right.
All content on this show is information of a general nature and does not address the circumstances of any particular individual or entity. Nothing in this show constitutes professional or financial advice, nor does any information on the show constitute a comprehensive or complete statement of the matters discussed or the law relating thereto. The Expert Exchange is not a fiduciary by virtue of any person's use of or access to this content. You alone assume the sole responsibility of evaluating the merits and risks associated with the use of any information or content on the show before making any decisions based on such information. In exchange for using the content, you agree not to hold the Expert Exchange, its affiliates, or any third-party service provider liable for any possible claim for damages arising from any decision you make based on information or other content made available to you through the show. The Expert Exchange is not licensed to practice law or provide legal advice. Nothing contained within this show is intended to be an offer to either buy or sell securities.